Welcome back to Corporate Radar. On our radar now are the results of Bank of Baroda. In the fourth quarter, the company's profits, of course, are higher. Advances growth at 13% is higher than what the banking sector has reported. But the stock suffered reverses largely because the net interest margins has come in clearly lower at 2.86% compared to 2.94% in the previous quarter and 3.27% in the year-ago quarter. The slippages rising quarter on quarter may have disturbed the market. Joining me now to explain all facets of the results is the Managing Director and CEO, Mr. Debadatta. Mr. Chand, thank you very much indeed for your time. Let me straight away come to what appears to have bothered the market, Mr. Chand. Slippages, what accounts for the rise in just one quarter, 8% higher?
So, Latha, thank you very much for inviting me. And again, I say that on asset quality, we have one of the best quarter we have for last many years now. On the slippage side, let me address that. On a full year basis, the slippage has been much lower. At the same time, the recovery has been much higher than the last year. And specifically coming to the quarter ending Q4 of FY25, the slippage is 2,800 crore, which is equally the same like the same slippage in the last quarter of last year. And sequentially also, the slippage is only higher by only 300 crore. Wherein the recovery for the same quarter to quarter, let's say Q4 over Q3, it is in excess of 300 crore incremental.
Okay.
So in that way, slippage is much under control. And we have been saying that on the asset quality, as I said, one of the best quarter. The GNP has been trending downwards for last many quarters and many years now. The net NP is down from the GNP is 2.26, is one of the best in the 13 years now.
Okay.
The slippage ratio, we had given a guidance of 1 to 1.25,
Okay.
whereas the slippage ratio for the full year is 0.78.
Okay.
And as compared to the last year, from 0.99, it has gone down to 0.78.
Okay.
The credit cost is all-time best now. The full year is 0.47.
Okay.
So I think asset quality-wise, there should not be any concern with regard to any slippage.
Okay.
The bank has the best of asset quality for Q4.
Okay.
The 300 crore of additional slippage, no way any impact to me because the incremental recovery has been much higher than that.
Got it.
So in that scenario, this is not a concern as far as the bank is concerned.
I take your point that the investor community will be reassured by what you're saying. But net interest margins was perhaps the other talking point in the market, coming down to 2.86. That's almost a 10 basis point fall from quarter ago, and of course from year ago it's looking like almost a half a percentage point fall. Is this the lowest? Do you see it improving?
See, we're given a guidance to the market for the full year at 3 to 3.10, right? And in that scenario, the global NIM is at 3.02.
Okay.
And the domestic NIM is at 3.18. And since we run a large international book where the margin is less, the global is slightly below the domestic NIM. Saying so, if I look at my the NIM on a quarter-to-quarter basis, the deposit actually, I'm carrying a rate-sensitive liability. I always said that my liability should react to the market in terms of the elevated cost. And that precisely happened. So going forward, the outlook is that I think the cost of deposit has picked out as far as the Q4 is concerned. There are two scenarios we are migrating while migrating to the Q1 of this year. That there is a rate cut or repo 50 bps that happened to the market in that way. At the same time, the liquidity has changed from a deficit to surplus for Q1. So considering both the scenario, I don't think any further pressure on the margin going forward. Okay. Rather, we have come true to our guidance in terms of the margin guidance 0.1. And for a full year NIM of 3.02, I think I am on the top quartile in terms of the large PSB peers. Okay. So there are very few maybe higher than me. So
but the overall NIM of 2.86 will be bottoming out. Do you think you will go above 3 in your overall NIM, that is domestic plus international, in the current quarter, April, May, June?
As far as quarter to quarter, yes, it has bottomed out. But let us also be mindful of two scenarios when you look for the full year FY25-26. One is a case where the repo rate cut has happened, so as the BRLR has gone down, right? At the same time, the deposit, we have moderated on the wholesale deposit that we see there is a cost moderation therein. On the retail, we reduced the peak rate from 730 to 710. So, but again, fresh deposit can only contract reprice at a new rate, not the old deposit.
Okay.
So there will be some lag effect on that.
Okay.
So the moment you migrate to Q3 or Q4, I think we'll catch up to a normalized margin of around 3% going forward.
Okay, I get that. Will your advances continue at nearly 13%? Many banks have guided for a lower advances growth.
We had a very strong, as you said, very strong advance growth last year. Actually, the domestic advance at 13.7%, and the global is at around 13%. We had given a guidance of 11 to 13, but we are again above 13 in that way, right? So that's point one. Secondly, my sense, retail continue to grow at 20%. One numbers you would have seen the MSME and agri growth, the growth for March 25 is 14.2%. So scenario when the liquidity back into the market now, I think we can upsize the growth by 1-2% more rather than maintaining the growth. So I'm quite hopeful of, upsizing the growth going forward.
So you're guiding for 14%?
We'll give a guidance on that matter, but we retain the guidance at 11 to 13, but we'll definitely exceed 13%.
Okay. Oh, that's good to hear. Now, let me come to the slippages, or rather the credit cost part again. With the recent decision of the Supreme Court in the Bhushan Power case, you have an exposure, I think, over 1,000 crores to Bhushan Power, which you got from JSW Steel. What happens to it? Have you to return the money? Will that alter your provisioning credit cost in any way?
See, as you said, my exposure is not significant. It's less than even 0.2% of my corporate book. So okay. Exposure is quite less. So it's a judicial process. So there is sensitivity surrounding the process. So let us respect that for the time being. For us, actually, adding any comment at this stage would be slightly premature.
Okay. What exactly is the exposure, sir?
And normally bilateral we don't disclose, but it is less than 0.2% of the corporate book.
Okay. Okay. No, I don't know if you can comment on this much. There is a point of view that even if this money has to be returned by the banks to JSW, the liquidation of the plant, liquidation of the company, Bhushan Power, will bring back maybe even more. There is a point of view like that. Would that be one way to look at it?
Slightly difficult because, again, the entire process is being guided by legal advice on the matter. So, okay. Actually, as a COC, I think, and the COC would take a call based on all these factors therein. There are legal counsel, advising on the matter, and possibly going forward, we'll hear more on that. Okay.
Fair point, sir. It's quite possible we hear from our reporters in Delhi that the government also could be looking at impleading itself in the review. We will have to wait and see. I wanted to ask you about your LCR as well. Do you have a lot of trust or wholesale deposits under the Reserve Bank's rules? Now you have to keep less liquidity for wholesale deposits which are of trust or LLPs. So are you going to get some relief? Are you over-provided on government securities and therefore you will have more money to lend?
See, as far as LCR is concerned, as on March 25, we're at 123 level, right? So it goes up and down based on different quality of asset you have both sides based on liquidity. So in terms of the draft guidelines and the actual guidelines, we have a substantial release there. Oh. On the draft guidelines, are almost an impact of 5%, but now it is not there. Okay. So in that way, it's something very positive. There would be augmentation of lendable resources for the bank for the matter. And we are quite comfortable on the LCR, and possibly will continue to map it out at the same level like 120, 123%.
Okay. What is your sense about demand? We saw State Bank saying that corporate lenders are deleveraging, they're returning money. Where are you seeing demand? Is it from unsecured retail? Is it from MSME? Where are you seeing?
See, there are two segments. As far as the March, you would have seen my MSME has gone up 14.2 as against 10% last year. So there is demand on the MSME 0.1. On the corporate also, we have seen good demand, particularly sector like renewable sector, the road sector, services sector. So there are good demands therein. So our normal guidance on the corporate growth is almost at 10%. And this year it has come to around 8.6%. But on the backdrop of a slightly tighter liquidity scenario prevailing in the market for the full year. So going for the FY 25-26, I think the liquidity is much better. And the demand will continue to be there. And I think we as a bank intend to grow more than 10%. There are a couple of, a big company, they are deleveraging, but there are few, additional capex demand coming from different other borrowers. So either way, that's a balancing out there.
Mm.
So with that scenario, I think a growth of 10% is something I think we can achieve that.
Okay. Two very quick questions before I run out of time. Can you give some guidance on cost to income ratio? Do you see it falling?
See, we intend to moderate on the cost to income ratio. We have something like on the top quartile of cost to income at less than 48 as on March 2025. The operating expenses we have controlled it tightly. It is growing less than 6% therein. So we continue to, reduce the cost to income going forward. But there are two factors we need to account for. One is a case my IT spend going to be higher as compared to previous year.
Mhm.
So a scenario where the spend is higher, obviously to put pressure on the cost side. Secondly, I'm also expanding. So on the branch network, on the zonal network. So accounting these two factors where there would be a bit of pressure on the cost side, but then we'll intend to maintain below 48. And with the opportunity, we can again optimize that and reduce it below the 47 level going forward. But all would depend upon how do I make a trade-off in terms of the cost and income structure.
Fair point, sir. And finally, should we worry about unsecured personal loans or any microfinance that you may have? What is the percentage to both these categories? And are you noticing any problems?
Absolutely not. Actually, in terms of my personal loan book, it is around 36,000.
Mm-hmm.
Last year also, as a percentage of overall book, it was at 13%. Retail book, it was at 13%. This year also continued to be at 13%, that is 0.1. We are not seeing any elevated stress in my book because the underwriting quality for last 2 years at least, we have improved significantly both in terms of the underwriting model and also the quality of this advance is concerned. As far as we are concerned, maybe 100 crore odd is the elevated one, which is much less.
Mm.
The book is running almost at 20%, so slippage ratio has been lower. At the same time, microfinance, I do have a very small book around 6,500 crore.
Mm.
And these are typically given to microfinance institution per se, and they are a good quality rated A and above. So there is no stress per se on that particular portfolio.
Okay, just a final one number. What is your GNPA or NNPA goal by the end of FY26?
We always said that we'll be trending downwards. So we don't give a guidance. The guidance we give on slippage ratio continue to be 1.1.1 to 1.25, and last year it was almost at 0.7.
Yes.
And the credit cost we say below 0.75, we are at 0.47.
Okay.
So with these two guidance, I think the trending would be clearly downward.
Okay.
If you look at this year also, the recovery has been higher than the slippage. And that is something very positive as far as the bank is concerned.